Today we're looking at the Vanguard Australian High Dividend Yield ETF, VHY, listed on the Australian Stock Exchange. We'll go over the ETF fact sheet, including the management fee, the index the ETF tracks, dividend yield, payment frequency, and the fund's performance. VHY is an ETF provided by Vanguard, who own and operate the fund. Vanguard are the ones who own the underlying shares in each of the companies. So when we buy shares in the ETF, we buy from Vanguard, who continually issue new shares in an open-end fund and not the individual company shares inside the ETF. VHY tracks the performance of the FTSE Australian High Dividend Yield Index before fees, expenses and tax. The ETF provides low-cost exposure to companies listed on the Australian Securities Exchange, or ASX, that have higher forecast dividends relative to other ASX-listed companies. Diversification is achieved by restricting the proportion invested in any one industry to 40% of the total ETF, and 10% for any single company. Australian Real Estate Investment Trusts, or AREITs, are excluded from the index. This ETF tends to suit buy and hold investors primarily seeking tax-effective dividend income containing franking credits plus long-term capital growth. It pays distributions, which are dividends from the ETF, 4 times a year with a yield of 5.1%, and has a management expense ratio, or MER, of 0.25% per year. So for every $10,000 invested, it will cost $25 per year, and this fee is automatically subtracted from the ETF unit price, so you won't actually see any fee transactions being paid or taken out of your brokerage account. Since VHY tracks the Australian markets, it is heavily tilted towards banks and mining companies. The largest portion of the fund, at 41%, is in financials, followed by materials at 22% and energy at 11%. Utilities, technology and consumer staple companies make up the smallest percentage of the fund, under 3% each. The benefit of investing in Australian shares is their historically high dividend yields due to the banking and materials sectors, along with franking credits to eliminate double taxation on company earnings paid out by dividends, with the possibility of getting a tax refund if your tax rate is lower than the corporate tax rate. The bulk of the Australian stock market returns have come from dividend reinvestment, leading to the compounding growth over time. Since inception, VHY has had an average annualised return of 9.36%, which includes both capital growth and distributions or dividends. Now, past performance is no guarantee of future performance, but it's always a good sign of consistently improving business fundamentals, driving each individual stock higher within the ETF. With dividends reinvested, the cumulative return becomes much better. Reinvesting these dividends creates the larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the sort of approach I take investing for the very long term using ETFs to one day live off the investment portfolio as passive income through either dividends or selling down small parts of the position. Let me know in the comments what you think of this ETF and whether you currently own any shares or plan to buy. Thank you for watching, and I'll see you next time.